Stephen Davies is founder and chief executive officer at Javelin Wealth Management to try and understand how does he see all of this. Stephen, good evening to you, I presume, out there, and thank you so much for speaking to us, and good morning from us here. Now, are you worried about a quote-unquote stagflation scenario in the US? And what could it mean for those markets after 2 years of just plain US exceptionalism?
Well, markets always run through different cycles, and obviously the US market had a big run up towards the end of last year, which carried through into January and the immediate aftermath of the inauguration of President Trump for the second time. During February, it's been more a question of starting to see and to speculate on what the effects are of a number of these policies. Obviously, the speed with which the Trump administration is moving at the moment is slightly head spinning, so it's taking a bit of time to work out the full implications of all the various policy proposals that are outstanding. But suffice to say, what we now look at as far as the United States is potentially higher levels of inflation. That's the reason why the Fed's a lot more cautious, perhaps, in its interest rate outlook. Conversely, we've had a switch of attention through to Asia and to a lesser extent into Europe. So both those marketplaces have been outperforming the United States during the course of February, and that's probably going to continue for a little while yet.
Okay. So, Stephen, from that perspective, hi, morning, Alex joining in as well. I'm wondering how you place your strategy. Are you confident enough about the signs that you're seeing from China to move out? Because right now we're talking about a situation where the US perhaps is slowing and maybe slowing faster than some had anticipated. And the inflation bugbear is not going anywhere, particularly because those fiscal policies by Donald Trump are going to be inflationary.
That is true. So I fully agree with you on your second point. Those policies will be inflation. The first point in whether or not one's confident enough to be moving money back into China, I think the answer is yes, but with still an appropriate degree of caution. A lot of people, including ourselves, have had very low weightings for China for obvious reasons for a very, very long time. It does appear, however, that the central leadership in China is finally perhaps getting the message. We've seen lots of mood music changes over the course of the last couple of months, most particularly topped off last week by the first time that Xi Jinping has actually been seen shaking hands with Jack Ma of Alibaba. That's quite positive, because if you cast your mind back about 3 years ago, the first trigger point for the major China sell-off was the Chinese central government moving against a lot of the tech players, and Alibaba in particular. So any sense that that position is beginning to change is positive. The reason for the remaining caution is that we need to see some real policy announcements which highlight government moves to dealing with the intractable problems of the property sector and the excessive amount of debt that is bedeviling that sector right now.
Okay, so the question therefore is this, I mean, in the Buffett is not investing in the US either. If we do not see US exceptionalism, if China is making a resurgence, and we were just pointing out how in the Lunar New Year there were some record 9 billion trips, etc., so on and so forth. So consumer confidence plus political posturing, everything looking okay. Is China the place where global flows largely go in the near term? Does it happen at the expense of other markets like India, for example, which have corrected in the recent past as well? How do you see that?
I think there is going to be an element of switching between emerging markets. That's undoubted. And obviously, India had a very strong run. Valuations remain fairly rich there, whereas China, you're looking at some very compelling valuations for certain key sectors outside of property. As far as the point about US exceptionalism, I think that's a description which highlights the degree to which US growth has been driven by ongoing productivity gains, technological expertise and leadership. That's not going to change overnight, The one thing that is holding the US market back, though, is valuation. It looks pretty expensive. So from that perspective, other opportunities look better, but you definitely have learned the lesson over many, many years. You never write off the US. We're still going to have a significant allocation towards that market because that's where the growth, margin growth, product leadership is still coming from.
Last point then, and a couple of weeks back, Stephen, we were speaking with a global expert, and they were talking about the last hurrah for the dollar and the likelihood of it losing a little bit of steam. Some part of that has already panned out, but do you anticipate a further weakening, and what are the factors that could lead to that?
Well, I think the position with the dollar really comes down to interest rates. And with the Fed taking a slightly more cautious view on interest rate policy, it therefore means that US interest rates are going to be held at these levels for longer than was originally anticipated. 6 months ago, the expectations for 2025 was 3 or 4 rate cuts. Now we're down to between 1 and 2, both of 25 basis points each. Higher interest rates is supportive for the currency. It's supportive for the dollar, particularly at a time when other countries and other regions like the Eurozone probably going to be continuing to cut in the face of stubborn issues with anemic economic growth. In the US, it's still looking better.
Yeah. Stephen, thanks so much for joining in for that perspective. Thanks so much for joining us and speaking to us on NDTV Profit.